What if I told you that the secret to becoming a successful investor has nothing to do with predicting the market and everything to do with controlling your emotions? In this video, we'll explore The Intelligent Investor by Benjamin Graham, the timeless investing guide that taught Warren Buffett how to build lasting wealth. Get ready to learn how to protect your money, think like a true investor, and make smarter financial decisions for the rest of your life. The Intelligent Investor by Benjamin Graham. Introduction: The timeless guide to smart investing. The Intelligent Investor is more than just a book about stocks. It's a blueprint for intelligent decision-making in the world of money. Written by Benjamin Graham in 1949, this investing classic has stood the test of time and shaped generations of investors, including Warren Buffett, who called it by far the best book on investing ever written. Graham's goal is not to help you beat the market, but to protect yourself from it. The book teaches you how to think logically, manage your emotions, and make decisions that prioritize long-term success over short-term excitement. It's about cultivating the mindset of an intelligent investor, someone guided by discipline, research, and reason, not emotions or hype. In essence, Graham's philosophy boils down to this: investing is most intelligent when it is most businesslike. Part 1. The difference between investing and speculating. In the opening chapters, Graham makes a powerful distinction between two very different approaches: investing and speculating. An investor, Graham explains, carefully analyzes a company before buying its stock. They make sure there's safety of principal and a reasonable return on investment. In contrast, a speculator is someone who buys and sells based on emotion, rumors, or market trends, hoping prices will rise quickly so they can profit. Most people, Graham warns, think they are investors when in fact they are speculators. They chase hot stocks, react to headlines, and treat the market like a casino. The intelligent investor avoids this trap by focusing on value, not price. They know that real wealth is built through patience, analysis, and consistency, not luck or timing. Graham's message is clear. If you want to succeed, you must stop trying to outsmart the market and instead learn how to outlast it. Part 2. The concept of Mr. Market. Perhaps the most memorable idea in The Intelligent Investor is the story of Mr. Market, a metaphor Graham uses to explain how investors should think about stock prices. Imagine you own a small business with a partner named Mr. Market. Every day he offers to buy your share or sell you his. The catch? Mr. Market is moody. Some days he's wildly optimistic, offering high prices. Other days he's depressed, offering low ones. The intelligent investor recognizes that Mr. Market's emotions do not determine the true value of the business. They only create opportunities. When Mr. Market is pessimistic, that's your chance to buy quality companies at bargain prices. When he's euphoric, that's your time to sell. The key lesson is emotional control. Don't let Mr. Market's moods influence your decisions. Use his irrationality to your advantage, and never confuse price with value. This concept teaches one of the most vital skills in investing: patience and emotional discipline. Part 3. The concept of value investing. At the heart of the book lies Graham's philosophy of value investing, the idea that investors should purchase stocks for less than their intrinsic or real value. The intrinsic value of a company is what it's truly worth, based on its assets, earnings, and long-term potential, not its current market price. The market can be irrational in the short term, but in the long term, prices eventually reflect true value. Graham urges readers to treat stock buying like business ownership. When you buy a stock, you're not purchasing a ticker symbol, you're buying part of a real company with real earnings and assets. The intelligent investor seeks companies that are undervalued by the market but have solid fundamentals. Over time, these hidden gems tend to appreciate as the market corrects its mistakes. This disciplined, rational approach is the essence of intelligent investing. It focuses on facts, not forecasts, and on value, not speculation. Part 4. The margin of safety. Graham's most famous principle, and perhaps his greatest contribution to investing, is the concept of the margin of safety. The margin of safety is the difference between a company's intrinsic value and the price you pay for it. The larger that margin, the safer your investment. For example, if a company's real value is $100 per share, and you can buy it for $70, you have a 30% margin of safety. Even if your analysis isn't perfect, that cushion protects you from losses. Graham compares this to building a bridge that can handle twice the weight it needs to, because unexpected things can always happen. The margin of safety helps investors stay conservative and avoid overpaying. It's a timeless rule. Never buy a stock unless you're getting more value than you're paying for. This principle transforms investing from speculation into intelligent risk management. Part 5. The defensive versus enterprising investor. Graham divides investors into two main types: the defensive investor and the enterprising investor. 1. The defensive investor is someone who wants a simple, low-effort approach. They value safety and consistency over excitement. Their goal is to protect capital and achieve steady returns. For this type, Graham recommends a balanced portfolio, typically 50% in high-quality bonds and 50% in reliable stocks. This ratio can be adjusted slightly depending on market conditions. 2. The enterprising investor, on the other hand, is willing to put in the time and effort. They seek better returns by doing deep research, identifying undervalued companies, and making strategic decisions. However, this requires dedication, patience, and strong emotional control. The key takeaway? Know yourself. If you don't have the time or temperament to study the market, don't try to act like an enterprising investor. It's better to be a wise defensive investor than a reckless speculator. Part 6. Stock selection for the defensive investor. For defensive investors, Graham lays out clear and conservative stock-picking guidelines. Choose large, financially sound companies with a long record of stable performance. Favor companies that have paid dividends consistently for at least 20 years. Avoid fast-growing or speculative industries that can be unpredictable. Limit how much you pay even for great businesses. Overpaying can turn a good investment into a bad one. Diversify your portfolio across at least 10 to 30 different stocks to reduce risk. In short, the defensive investor seeks quality, consistency, and simplicity. The goal isn't to chase high returns. It's to preserve wealth and let time do the work. This approach proves that steady, disciplined investing often beats flashy, high-risk strategies in the long run. Part 7. Stock selection for the enterprising investor. Enterprising investors, meanwhile, take a more active role. They look for undervalued and overlooked opportunities, the kind most investors ignore. Graham suggests several strategies. Hunt for stocks selling below their tangible book value. Focus on companies with low price-to-earnings, PE ratios compared to industry averages. Look for temporary problems, not permanent ones, like a company hit by bad news but with strong fundamentals. Consider special situations, such as mergers, reorganizations, or spin-offs, where short-term uncertainty may create long-term profit potential. This style of investing requires curiosity, research, and emotional strength. The market often punishes good companies temporarily, and that's when the enterprising investor seizes opportunity. In Graham's words, the intelligent investor is a realist who sells to optimists and buys from pessimists. Part 8. Bonds, inflation, and asset allocation. Graham also devotes significant attention to bonds and inflation, two key factors in portfolio management. He recommends that investors always keep a balanced allocation between stocks and bonds. Bonds provide safety and steady income, while stocks offer growth and protection against inflation. However, Investors should be aware of inflation's silent danger. It erodes the real value of fixed income investments. Over time, a dollar buys less, so relying solely on bonds or cash can be risky. Stocks, on the other hand, generally rise with inflation, as companies can increase prices and profits. Therefore, a mix of both assets gives stability and growth potential. The intelligent investor adjusts their ratio of stocks to bonds depending on market conditions and personal tolerance for risk, but always maintains diversification. Part 9, Investor Psychology, the Real Challenge. Graham believed that the biggest obstacle to success in investing is not knowledge, but emotion. When the market rises, greed takes over. When it falls, fear dominates. Most investors let these emotions dictate their actions, buying high and selling low. The intelligent investor, however, stays rational and disciplined. They understand that market fluctuations are normal and even beneficial because they create opportunities to buy undervalued stocks. Graham's advice is simple but powerful. Be patient when others panic. Be cautious when others are greedy. Focus on your long-term goals, not daily headlines. Controlling your emotions is harder than analyzing numbers, but it's far more important. In investing, temperament beats intellect. Part 10, The Role of Financial Advisors. Not everyone has the time or expertise to manage their own investments, and Graham acknowledges this. He advises that if you seek professional help, choose advisors wisely. A good financial advisor should not promise unrealistic returns or market predictions. Instead, they should help you design a rational investment plan, encourage consistency and discipline, protect you from emotional mistakes, like panic selling or overtrading. Graham reminds readers that even with guidance, the responsibility ultimately lies with the investor. You must stay informed and ensure that your advisor's actions align with your long-term interests. The best advisor, he says, is not one who predicts the future, but one who keeps you from self-destructive behavior. Part 11, Case Studies and Real-World Lessons. Throughout the book, Graham supports his theories with real-world examples of both success and failure. He examines investors who lost fortunes by chasing trends, such as those who jumped into the 1929 stock market bubble or the tech boom decades later. He also highlights disciplined investors who quietly built wealth through patience and analysis. The lesson is clear. History repeats itself because human nature doesn't change. Whenever people forget the principles of intelligent investing, they eventually relearn them the hard way. These examples remind readers that markets are cyclical, and true success comes not from timing the market, but from time in the market, guided by wisdom and discipline. Part 12, The Modern Relevance of Graham's Wisdom. Though written more than 70 years ago, The Intelligent Investor feels strikingly modern. In today's world of meme stocks, crypto speculation, and social media hype, Graham's message is more relevant than ever. Focus on value, not popularity. Don't get swept up in short-term market mania. Treat investing like owning a business, not playing a game. The book's enduring power lies in its simplicity and psychological insight. It reminds us that markets may evolve, but the human tendencies of fear and greed remain the same. By mastering those tendencies, you'll stand apart from the crowd and become a truly intelligent investor. Conclusion. The core message of The Intelligent Investor. Benjamin Graham's The Intelligent Investor is not about getting rich quickly. It's about getting rich wisely. It teaches that the true measure of investing success is not how much you earn in a bull market, but how well you protect yourself in a bear market. Being an intelligent investor means thinking independently, staying calm under pressure, focusing on value, not noise, always demanding a margin of safety. Ultimately, this book is a guide to emotional and financial maturity. It teaches you that intelligence in investing comes not from IQ, but from patience, discipline, and self-control. As Graham famously wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. If you can master your emotions, the market will eventually reward your wisdom. And that's the heart of Benjamin Graham's The Intelligent Investor, a book that reminds us that investing isn't about luck, timing, or market trends. It's about discipline, patience, and emotional control. If you can master yourself, you can master the market. So take these lessons to heart. Focus on value, demand a margin of safety, and stay calm when others panic. That's how intelligent investors build wealth, not overnight, but over a lifetime. If you found this summary helpful, make sure to like, subscribe, and turn on notifications so you never miss another book that can change the way you think about money and success. Thanks for watching, and remember, true intelligence in investing begins with wisdom, not emotion.